Since time immemorial, gold has been more than just a metal in India. It's a symbol of love, security, and blessings, a treasure passed down through generations. Every Indian celebration, a wedding, a festival, or the birth of a child, shines brighter with gold. It's gifted to daughters as a mark of blessing, given to sisters as a symbol of love, and treasured by mothers as a promise of protection. Gold in India isn't just bought, it's cherished. But times are changing. Today's generation is writing a new chapter where tradition meets technology. Instead of locking away physical gold, smart investors are turning digital, exploring gold, ETF, and gold mutual funds. Because while our love for gold hasn't changed, the way we invest in it has evolved. In 2025, more Indian investors are embracing digital gold, offering ease, safety, and transparency. No more worries about storage, purity, or theft, yet you can still grow your wealth with every rise in gold prices. So, let's break down the two most popular ways to invest digitally in gold: gold ETF and gold mutual funds, and find out which one truly delivers higher returns. Gold ETF are traded on the stock exchange just like shares. Each unit reflects the live market value of gold. You can buy or sell anytime during market hours, full control and full transparency. Gold mutual funds, however, invest in gold ETF on your behalf. No demat account is needed, and you can start small with SIP, even as low as 500 rupees per month. Professionally managed, they are perfect for long-term, disciplined investors. Leader pros and cons in real-life terms. Gold ETF. Directly linked to live gold prices. Low expense ratio, 0.1% to 0.3%. Trade anytime on the stock exchange. Requires a demat and trading account. Brokerage charges apply per transaction. Gold mutual funds. No demat account required. Start SIPs easily from 500 rupees. Professionally managed for long-term growth. Slightly higher expense ratio, 0.25% to 0.5%. Not as liquid, transactions occur only once a day. Taxation and cost efficiency. Tax rules are identical for both. Sell before 3 years. Short-term capital gains taxed as per your income slab. Sell after 3 years. Long-term capital gains taxed at 20% with indexation. So the difference isn't in taxation, it's in cost efficiency. ETF usually gives slightly better returns due to lower expenses and zero fund management fees. Fact: both ETF and gold mutual funds track gold prices. ETF need a demat account, mutual funds don't. Both get long-term tax benefits after 3 years. ETF trade live. Mutual funds transact once daily. Gold mutual funds invest in ETF, not physical gold. Which one should you choose? If you value flexibility, real-time trading, and lower costs, gold ETF are ideal. If you prefer a hands-off approach, investing slowly through SIP without worrying about demat, gold mutual funds are perfect. Both options help diversify your portfolio and protect your wealth. Gold has always been India's emotional asset. Now it's becoming a smart financial one too. While the world changes, one thing remains timeless: our love for gold. From the hands of our mothers to the screens of our digital apps, gold continues to protect, empower, and connect generations. The question isn't whether you should buy gold, it's how you choose to own it. And today you have smarter, safer, and stronger ways to do just that. If this video helped you understand gold investments, hit like, share, and subscribe to Finance for the Street, making money simple for everyone.